With the S&P 500 making new all-time highs, every week is a historic week. However, market price action is not reflective of the broader market, as weaker data is showing clear signs of a slowdown. So what exactly does this mean for stocks, and should we hedge, liquidate, or hold? Today, that's what we're here to discuss, along with where to find value as we tackle the ins and outs of the equal weight S&P 500 and the Russell 2000. We're going to look at price action, key levels, and my expectations for both these middle child indices. We're also going to talk about Q2 earnings season, which kicks off this week, buybacks, and how you want to be positioned for rate cuts. What exactly does this all mean? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. So if you like this video, please subscribe, hit that notification bell, like this video guys, and leave a comment for the algorithm. Let's get into it. Now this is the weekly heat map of the S&P 500, and it's almost like a set of stairs if you look at it like this, right? One part of the heat map is green. This would be the growth side, and then everything else was in the red. And the reason why I call it the growth side is because there were multiple sectors in the green this week, the majority being technology, the bigger names Microsoft, Apple, Google, Meta, Nvidia, as well as a huge contingent in financials. And then we had the stuff like Johnson & Johnson, United Healthcare, they were in the green, while the rest of healthcare was in the red. All of industrials were pretty much in the red. That had to do with the PMI data, energy 2, utilities, basic materials, and then the defensive part here of consumer staples, as well as everything that wasn't the Mag 7 in discretionary, they were in the red. Everything else was in the green. So if it was growth centric, in the green. And a prime example of this is literally just software here. However, if we do dive a bit deeper, we did see a couple of outliers that we should really be concerned about right here down in basic materials. If we dive in deeper, you can see stuff like GDX, right? Up 6% for the week. In fact, silver miners, this is gold miners, silver miners would actually be in second place right under GDX. Look at stuff like XME up 1.29%, just underperforming the SPY for the week. So what we actually saw was growth, the Magnificent Seven. Look at stuff like discretionary, semiconductors, technology, communication services. They all outperformed the SPY, as well as gold miners, silver miners, and then the metal and mining industry. It all has to do with earnings. The Magnificent Seven are the earners in the market right now, and that's why the market is positioning themselves into them. They've been the best performers, and they probably will continue to outperform this year. But we're also seeing a lot of movement due to incoming rate cuts, and that's why we're seeing a lot of movement in GDX, silver miners as well, commodities too. But the worst performing sectors this week was stuff like ITB, home construction, regional banks. XLRE was barely in the green. So these are like rate sensitive sectors. And then stuff like XLU, XLV, XLE to a degree. These are defensive sectors, I guess. But then XLE and XLI had their own issues going on. Crude had a massive run prior to this. So I think that's just the market giving a bit of the gains back. And then XLI had some terrible PMIs, industrial global PMIs and US PMIs didn't come in so good, and that's why industrials were there. So the sectors that got sold off this week were defensive sectors and rate sensitive sectors. But then diving even deeper, we have a look at the major indices. TLT this week was up 2.4%, which means if TLT is up, yields actually fell. So now you have to answer the question, why would yields fall and rate sensitive sectors get sold off? It has to do with the risk on environment. You see, you can either position yourself for rate cuts in stuff like XLRE, real estate, home construction like ITB, maybe stuff like XLF financials or regional banks, right? Or you can position yourself in stuff like tech names. And because the economy is looking strong, I think growth is weakening. We're going to talk about it in the video today. But because the economy is still very strong, jobs are strong, employment is strong. If we are going to get rate cuts to normalize policy in a soft landing environment, you want to own growth because everybody's going to benefit from that. These names as well as the growth names. And in that scenario, growth will outperform. And that's why we're seeing these growth sectors, the Nasdaq 100 being bid up 3.3% today, beating almost everything. It beat bonds. Bonds were the second best performing major index, TLT up 2.4%, and then the S&P 500, the Dow Jones up 0.38%. So yeah, it was mega caps and bonds that really outperformed, outshined this week. And then the real losers was pretty much everything else, the broader market that wasn't mega cap or tech or growth. And then the IWM, small cap names, down 1.33% and 0.6% respectively. Now let's actually dive into the RSP and the IWM just to see what happens, what comes next for these, because we do know that momentum is on the side of the S&P 500 as well as the Nasdaq 100. We do know that rate cuts are coming. That's why bonds are catching a bid. But what about these unloved parts of the market. Let's talk about it. So the RSP, the equal weight, for those of you that don't know what the RSP is, the RSP or the S&P 500 equal weight simply takes all the stocks in the S&P 500 and weights them equally. Equally weighting greatly increases the footprint of smaller S&P 500 stocks, many of which we consider to be mid-caps, which result in higher beta for the portfolio. However, equally weighting also lowers concentration, reducing blow-up risk from any one name. While one should expect some sector bias here as well, RSP does not equal weight sectors as some peer equal weight ETFs do. So every stock in this index, once rebalanced, has a weight of 0.20%, and it's actually done very, very well. This is the monthly chart, and you can see in a very, very clear uptrend, having recently made new all-time highs just a couple of months ago. So in an uptrend on the monthly, you don't want to fight the trend, and really this looks very, very healthy. It does look healthy. We saw a massive move up right here, and we saw a pullback / a correction in time here in 2022, 2023, and then towards the end of 2023 into 2024, we saw a massive move back up to all-time highs. Now we're coming a bit off those highs, but I still think this looks very, very constructive. And you know, if you are a technical analyst, you'd look at this and say, yep, we're sort of flagging right here. The next move is probably going to be to the upside or the downside. And based on the trend of this market, you probably want to look to more an upside bias. Now on the monthly chart, right, there's some very, very key levels that, let's say if we are to pull back, that I would want to be a very, very strong buyer of. And it's just this level right here. The reason why this is a very, very key level in the RSP is simply because we used it as resistance right here, here, and here. Then resistance turned to support at this section right here. And then we broke out to new all-time highs. So if the RSP does pull back all the way to the 154 level, I will be a strong buyer because I do think we're going to find strong support right here and then move higher. Now, that is the monthly chart. Digging a bit deeper into the weekly chart, we could see this 154 area. If we just zoom out, this is where we stand right now. So the 154 area was sort of the place where we were at the start of the year. Now the RSP can actually go ahead, make a lower low, break through this, use it as support. And even if we do make a lower low right here, as long as we hold this level right here, which again, we used as resistance multiple times, we should see a bounce. And if we could break some of the key levels on the way down, that would then be bullish and we can go ahead, make new all-time highs in the RSP. So 154 is the level I'm looking at. Now that is the monthly key levels. What about the weekly? The weekly, this is the level right here. It's the 158 level, and very similar to what happened at the 154 where support becomes resistance. We can see a resistance turned into support. We broke out. We used it as support right here as well. At this point, broke above, but we couldn't go ahead and make new all-time highs. And now we are actually in a weekly downtrend, which would mean we're in a daily downtrend. And if we are to move lower in the equal weight on the weekly chart, I think this is the first level where we should look to find support. If we do break, then we would probably look to the 154 levels. If we don't find support right here and move higher, it probably means we attack the 158 level and the 154 level on a weekly chart. Now, looking at the daily chart, this is where things look a little bit dicey, right? Because there's multiple regions where if the RSP doesn't really hold this level right now, and we have seen quite a bit of support at this level, but it does produce some risks, because if we do break below this level, right, that's going to be a very, very strong resistance zone. And then we're probably going to the 158 and maybe 154 level. So if you're a buyer of the equal weight on a technical chart, you want to find support right here. Okay, maybe a move up this week very, very quickly, break some of these key levels and go and hit new all-time highs. That's what you want to see in the RSP, or at the very minimum, you really want to have a move higher and go try and break the 166, 167, maybe even the 168 level here. That's what you want to really go do very, very quickly, because the longer we trade here, the more likely it is that we can actually see a bit of a breakdown, particularly with the rotation we are seeing in the mega cap names. So strong support zone. Don't get me wrong, but if we do break below, we'll see 158 coming very, very quickly in the RSP. So those are your levels right there. If we don't find support right here, we break below, use as resistance, our downside targets will be 158, 154 in the RSP. But if we do hold here, our upside targets are 166, 168 in the RSP. Now let's dive into the IWM. So this is small caps, and you guys all know what the IWM is. It just tracks the Russell 2000 index and has most of its market cap in a couple of mid-cap names, but mostly small cap and micro cap names. Now let's actually go into the monthly chart and have a look. Now, firstly, we could see a couple of things. We are in an uptrend. We are clearly in an uptrend The problem arises when we start to zoom in. That number one, we had the COVID move up here, 2021. We made new all-time highs at the 250 level, pulled back, made a correction in time in the IWM, and still haven't gotten back to those all-time highs. And that's because these companies haven't had the earnings to back up the price action for a move back to all-time highs. A lot of companies are still lagging the earnings they saw here in 2021, 2022, and that's why we're simply not back there. But that is set to change. Russell 2000 earnings are set to come in very, very good. This index on a technical basis is looking a little weaker than almost every other index. Now, the very first thing I want to note is this level right here, okay? The 194 level. Some would even say as high as the 200 level. Very similar to the RSP, very similar price action. We use it as resistance right here, and then we try to break above, and we've used it as support multiple times, looking for a break above and a move back up to new all-time highs. Now, how far are we actually from all-time highs in the Russell 2000? We're 21% away. So technically still in a bear market here in the IWM. Looking at the weekly chart, we can see things on a more nuanced level. So we can see right here, resistance, 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 broke above. This level has now turned into support, and it's offered very, very strong support. Yes, we've had a couple of days where, yes, we've had a couple of weeks where we've wicked below, but this level has remained very, very strong. And I do think that as long as we hold this level right here in the IWM, we probably see a move higher and a bounce higher all the way up to new all-time highs. A break below this level can be absolutely disastrous, especially if we break below some of these levels right here, because then the next level lower is probably like the 170, 165, 160 level in the IWM. There's not a lot of volume to support price below like the 190, 185 levels. So small caps in a bit of danger at this point right here. This was a 52-week high. Don't get me wrong, but you know, we've since made lower highs, irrational trading, very erratic trading here in the IWM on the weekly chart, and not much to look at. Again, I would use the monthly line of 194 as the weekly line of support. I think you want to be buyers of dips all the way down to the 194, especially with the earnings that are going to materialize in the IWM. We're looking at something like 30%, 40%, 33% earnings quarter over quarter throughout the rest of 2024 into 2025. So I think the market is just waiting for those earnings to materialize. Now on the daily chart, we are in a daily downtrend. We simply are in a daily downtrend. And again, we just want to use this 194 level. This is the key level. So with the IWM, if we do come here, I'd be a strong buyer in the IWM at the 194 level. But if we do break below here, things can get a bit dicey. Then we would look to some of these lower levels, but you know, they're not very strong support levels, and then there isn't too much price discovery. So things looking a bit dicey for the IWM, looking a bit stronger in the RSP. I am a buyer at 194 here for the IWM and the 164 level for the RSP. But what I would really like to see the IWM do is just break some of these 52-week highs and just make a move up closer to the all-time high area, somewhere up here. Maybe a move above 210, 212, and then we go from there. Now the S&P 500 has come off a pretty amazing quarter. Now we have some seasonal stats on how to play the market momentum. Now this right here is the Nasdaq and S&P 500 performance from the 8th to 15th of July. So this is about a week and a half worth of trading, when the trailing quarter, April 8th to July 8th, is up at least 5% over the last 50 years. This actually hit right here in 2024 in this period, and normally the returns we can expect for the Nasdaq right here and the S&P 500 are as follows. So the Nasdaq, very, very bullish, average return 2.02%, and this is 7 days of trading, 22 wins, 2 losses. In the S&P 500, we have 19 occurrences, 17 wins, 2 losses, average return 1.47%. So over the next 7 to 8 trading days, things are looking very, very bullish, and that actually aligns with July seasonality. The first half of July, so the first 2 weeks, is actually the best 2-week period in the year, and it just has to do with funds rebalancing their portfolio for the rest of the year. This is median 2-week S&P 500 returns, and you can see the first half in July normally returns just under 2%, but then we actually have a look at the second half of July right here, and then it reverts back to the average of just over 0.5%. So you really do want to be long in July, and you want to be long early in July because we do see outsized returns, and this is what July seasonality looks like. We see very, very linear returns in the first 2 weeks, pretty much flat returns, making a higher low, and then actually going to exceed this high we made in the middle of July at the end of the month. This is what monthly seasonality typically looks like. Now, it's not a crystal ball, but it does allow us to assess probabilities as to what will happen next. Normally, we can see average returns of 1.3%. Now, along with big funds buying to balance their portfolios for the second half of the year, part of the reason why we're seeing such dynamic market momentum has to do with client buybacks. The S&P 500 4-week average buybacks is looking very, very strong, very similar to the strength we saw here in 2021 with regards to buybacks. And that's because these companies are making money, particularly the mega caps. A lot of these buybacks are driven by Apple, Microsoft, Google, Meta. And that's why these mega cap companies are also rallying, because they do have a floor underneath them, and that floor is buybacks. But as we do enter the second quarter of earnings season, we will actually see those buybacks enter a little bit of a hiatus as they enter the earnings buyback blackout period. Now, this buyback blackout period is set to increase here towards the end of July into August, and the peak should be around the start to middle of August before it does taper back off. So a lot of the market momentum we are seeing might come to a little bit of a halt in the second half of July, early August. That's actually what seasonality tells us will happen, and that's because of some of the structural flows in the market. So companies entering their blackout period means earnings is around the corner, and Q2 earnings season kicks off this week. You guys know it, I know it, we spoke about it on Friday's video, and we're kicking the week off here with Pepsi and Delta Airlines on Thursday, and then some of the bigger banks here on Friday, JP Morgan Chase, Wells Fargo, Citi. And the week after that, we have Goldman, BlackRock on Monday. Then we have Bank of America, Progressive, United Health, Interactive Brokers, Morgan Stanley, Charles Schwab. Then on Wednesday, we have some of the bigger names, United Airlines, Johnson Johnson, Discover Financial, ASML. Thursday, we have Netflix, DR Horton, Intuitive Surgical, Domino's Pizza, and then Friday, American Express. Now, that is the first 2 weeks of Q2 earnings season. We'll cover the rest of the weeks later. We still haven't gotten all earnings dates yet. We don't have dates for Apple, Microsoft, Meta, these bigger names. So we're still awaiting those. But when we do get them, we'll talk about them. But as it is right now, this upcoming week is Pepsi, Delta Airlines, and then some of the bigger banks. Now, where do we stand for Q2 earnings? This is blended earnings growth. And right now, we've actually had 19 companies report in the S&P 500. You can see here that of the 19 companies that have reported, 82.4% have reported above analyst expectations. This compares to the long-term average of 66%. You can see that the S&P 500 blended earnings growth rate right now is actually 10.1%. At the start of March, early April, we were looking at 8.8% here on the earnings side, revenue sitting at 4.1%. This actually has come down compared to the 4.6 level we saw here on the 31st of March. So we've seen a bit of downward momentum in overall revenue, but upward momentum in earnings. And I think this has to do with the 19 companies that have reported earnings. The best sectors, if you really want to look at this earnings season, is comm services, healthcare, and technology on the upside. On the downside, it's really the material sector and industrials, but I'd also really watch the energy sector. This is actually going to be the quarter where the energy sector is going to exit the earnings recession, reporting revenue of 6.3% and 11.4% on the earnings side. And the energy sector has been a real drag in overall earnings in the last 3 to 4 quarters. So to see the energy sector return back to growth is very, very good. That's why we're actually seeing such dynamic S&P 500 earnings in the second quarter 2024. Now, this is an interesting note here from Deutsche Bank. They say, we see the S&P 500 EPS rising sharply in Q2 while the consensus sees them going sideways. So we do know that right now earnings is sitting at about 10.1%. Deutsche Bank forecast earnings to rise sharply from about the $60 to $65 mark. And that essentially means that what they see is earnings growth to be probably closer to the 11% mark than the current 10.1% mark. And they say Deutsche Bank is optimistic about S&P 500 quarterly earnings and expects them to rise further to another new high, supported by the expectation of resilient corporate earnings and the potential for US economic growth. Now, I don't necessarily agree with this. I think we are definitely starting to see a bit of a slowdown in growth, but we're going to talk about that in the video. At the same time, a massive ramp up in earnings is actually completely normal. This right here is S&P 500 trend. This right here is S&P 500 earnings into bear market bottoms. This is the 2022 bear market bottom, and then the average growth in bull market. So essentially, we start the bull market right here, and what do earnings look like? And this is the average earnings trend, and we normally see very aggressive trailing 12-month earnings. And this purple line right here is the current path of our earnings, where we are and the trajectory to the historical average based on analyst estimates. So while earnings may seem aggressive, it's actually well within historical means. But with earnings looking really hot right now, what about the economy? This is the Fed's GDP Now data, and we've seen this go from as high as 4% here at the start of May to where it's sitting now, very close to the 1.5, maybe even 1.6 level, the Fed GDP Now. And we've seen a steep decline, and this has to do with just the economic data we've received. This is Citigroup's surprise index. Now, this is for the US specifically, and you could see that the reason why we actually had a very strong rally through most of 2023 had to do with the fact that economic data came in very good. When this line is above the zero line, that means economic data is surprising to the upside. That's a good thing. Below this line, economic data is coming in weaker, surprising to the downside. That's a bad thing. And you could see at the start of 2024, right, we had fairly upbeat data up until about early March, late Feb, where we actually did see sort of like the data deteriorate very substantially. We saw mild relief here at the end of May, and then continued deterioration after the jobs numbers got reported right here. And the reason why jobs numbers saw a massive move down despite reporting above consensus by 16,000 at 206K was because we saw 111,000 job revisions in the prior months, which is significant. So the data is coming in weaker, and as a result, rate cut expectations are moving up. Now, this is the probability of a September rate cut. So this is the current Fed funds. 1 month ago, it was a 50% chance that we were going to keep the 525 to 550 basis point Fed funds. Right now, that's sitting at 22%. We could actually see the probability of a September cut is now actually 72% here at 500 to 525. This represents a 25 basis point cut. 5.9% chance of a 50 basis point cut in September. And just a week ago, just 1 week ago, this was at 57%, and 1 month ago, this was at 46.6%. So as economic data has deteriorated, rate cut expectations have moved up into a potential cut in September. And I believe what we are seeing is a bit of a slowdown. The economy is not in a recession. We're in just a slowdown where things are okay, but slowing. If left untreated though, you can get a recession from this, but this isn't where we are just yet. I'm not saying a recession is here, but the growth landscape has shifted considerably, particularly over the last month. So economic growth is definitely something we're going to unpack heavily in this week's video. So go ahead, subscribe so you don't miss it, because we're going to talk about the economy a lot this week. But at the end of the day, you do have to look at it. Rate cuts are coming to normalize policy, not because of a hard landing just yet, and that's normally bullish for equities. So this is returns before and after the Fed cuts into a soft landing. So normally after we get a cut, we can actually expect returns 6 months later of about 6% in the S&P 500. So if this is a September cut, we normally get sideways action and then a ramp up and seeing returns, above 6%. And normally 6 months before the initial cut, we actually see gains of 10% in the S&P 500.